Hello everybody and welcome back to the channel. If you're new here, my name is Josh. I'm a certified financial planner and I run a wealth management firm called Haven. Now today we got a fantastic question from a member in our free community and it asks, okay, this is awesome and I think a lot of people need to hear about this. I'm in a situation now where I have money to invest, but with all of the uncertainty going on and the talk I've heard about the markets being overvalued, would I still be best off to just invest the money as a lump sum? Should I dollar cost average in? Should I wait on the sidelines a little longer? I'm just not sure how things will react with tariffs coming, etc., and all these headlines. That is a fantastic question, and it's something we have to tackle with clients every week and every month. And so today I want to dive into the way that I approach this problem. And I think there are two main ideas to help us tackle this problem. And so one is going to be technical and one is a little more philosophical. So let's start with the technical one, okay? The best thing to understand here is a concept called rolling returns. If you can get familiar with this idea of rolling returns, it's going to help you in your financial planning and the way that you make investment decisions. So if you look at cash, if you look at bonds, if you look at houses, if you look at stocks, any investment really, the returns these investments exhibit will show us a very different picture depending on the time frames that we look at. So let me show you this here. Here I'm using a technology called Portfolio Visualizer, and what we have is we're comparing two different portfolios. One portfolio is 100% the US stock market. So as far as public investing goes, investing in public securities, that's about as aggressive as an asset allocation could get. And then we have Portfolio 2, which is a lot more conservative. This might be for some short-term goal or someone with a very low risk tolerance. They have 60% of their money in the bond market, 30% in stocks, and 10% in cash. And so we're going to compare these two portfolios. And what I want us to look at, like I said earlier, was this idea of rolling return. And so what rolling returns tell us isn't what does a particular investment do from year to year? It says, okay, what is a particular portfolio going to do on average over 2 years or 3 years or 5 years or 10 years? And so as you can see here, if we look at a 1 year roll period, the best an all stock portfolio is ever going to do is up 62%, which is huge. And on average, it'll be up about 12. I mean, that's pretty aggressive. That's past historical returns. And the worst it'll ever do is it'll be down 43% in a year, which is a lot. Whereas Portfolio 2 over 1 year is going to average about 7. The best it'll ever do is 22, and the worst it'll ever do is 14. So you can see how one of these portfolios, the one with more fixed income and cash, way more stable from year to year. But let's look over maybe a 5-year rolling period. Okay, so if we look at a 5-year rolling period, what is the worst sequence of returns that we could get? Well, over a 5-year period, the worst that we could be down is about 6.23%, and the high would be 26%, and the average is about 10.5. Over 15 years, the average is about 8, so you can see how the averages get lower, but the percentage that you are down year over year over year goes to 0. It's actually that now the lowest you'll get is 4.25% per year. And the highest you'll get is 15.7. So as we increase the time frame, the odds that we have negative returns decrease, and the odds that we have insanely high returns also decrease. But all I'm saying here is when we're trying to make a decision of when should we invest, we have to think about what is the time period that we're investing for, right? If we look at Portfolio 2, this would be more applicable or apt for someone who has a shorter term goal, right? Because over a 5-year period, there is no chance of it being down. Whereas with a aggressive portfolio, there are many periods where it's going to be down. And so as a rule, what you would like to do is have an asset allocation or a portfolio that matches the goal that you're pursuing, right? If you have a 5-year goal, you'd like to have a portfolio that doesn't have any chance of going down over 5 years. And so this portfolio might be a little too aggressive. But if you have a 5-year goal, this more conservative portfolio might be a great idea because statistically it has 0 odds of being down over that period, right? And so all these decisions around timing, when should I get in, when should I get out, can way more easily just be solved by having the right asset allocation for a specific goal. The only reason you should ever break that rule is if you have an incredibly high risk tolerance or you're totally okay with just delaying the achievement of a goal if markets are down at that time. So you could say, hey, well, I like the idea of investing for 5 years really aggressively because I might be able to get some really great returns, but in the off chance that I get a bad string of returns, I'm okay with that. If that's you, then you might be able to invest a little bit more aggressively. You can kind of break that rule a little bit, but it really comes down to when do I need this money? What is the goal? What's the time frame? And how can I match my asset allocation to that, right? That's kind of the technical explanation. Another thing to look at here on the technical side is the whole dollar cost average versus do a lump sum. This is a great chart from Dollars and Data, which is a great quantitative investment blog. And it shows us this data back to, this is 20 some odd years, 25 some odd years worth of data, maybe 30 years worth of data. And what it's showing us is The amount of time this line is above zero is the amount of time that dollar cost averaging beats doing a lump sum. And the amount underneath it is the amount of time that it underperforms doing a lump sum. So the amount of area or the amount of time this chart spends under this line shows us how often a lump sum will beat doing dollar cost averaging. And so one way to think about this is that if you want a smoother ride and less volatility, dollar cost averaging tends to be better. If you want better returns and better performance, doing a lump sum is statistically better. And so if I had to rank these, what should I do? Should I lump sum, dollar cost average, or try to time the market? I would rank them exactly in that order. I personally would do a lump sum first. That's always my first priority. Dollar cost average second. That would be the second priority if I, for whatever reason, which is rare for me, want a smoother ride and I'm willing to give up some return for that. And lastly, timing the market, which for most people should never be done and might only be done if you're sophisticated under very specific circumstances. So the main takeaway here is that when you get in or how you get in should mostly be an asset allocation problem, not a timing problem. And it should be dependent on the goal you're investing for, right? And so you need a financial plan to make those decisions. Can you see now like why in our program here, like it's all about financial planning? Because if you don't know your values and your visions and your goals and you have a timeline for each goal you're trying to achieve in your life, there's no way to really know if you should get into the market now or if you should get it later or if you should try to time it. And if you don't have absolute confidence and clarity on when that goal is coming up and how you're going to invest for it, it's going to cost you a lot of money over the long haul, over the course of your life by trying to like be tentative about when am I getting in, should I get out, all these sorts of things. And so once we have this plan, then we can understand how much do we need to be contributing towards each goal. That's like our little back of the napkin vision cost calculator spreadsheet. Here's all the goals I have. Here's how much I need to be contributing. Am I on pace for those or am I behind? You can just do the math to see if you're on pace. And from there, you can determine how much of a lump sum needs to go into any of these goals at a specific moment. So that's the purpose of financial planning. And so lastly, once you know what goal you're allocating towards and you know the timeline for that goal's achievement, then you can match the correct asset allocation given the rolling returns that you want for that goal, if that makes sense. So this is the importance of financial planning. And the only time in our system that you're allowed to break that rule is if you are totally 100% okay with delaying the achievement of your goals if the markets are down. That might allow you to be a little more aggressive, okay? Now, on a philosophical note, I want to show you this chart, which is amazing. And what it shows you is just the idea that human innovation always trumps fear. Pessimists sound smart and optimists get paid. Pessimists can sound cool to all their friends because they always have their finger on the pulse of what's going on. This piece of news is going to impact us. Oh, AI, blah, blah, blah. The wealthiest people I know are optimists. And they're constantly taking bets, assuming that the future is going to get better. And so this is a philosophical thing. We need to be optimists in order to have investment success. And this is a great chart that will convert you into being an optimist. Because what it shows is the performance over time of the stock market over 100 and some odd years. And every single major event that took over headlines and made people think, wow, this is a once in a lifetime experience. This is incredibly unique. Everything from the Spanish flu to World War I to World War II to the Vietnam War to all these different things. You have COVID, right? All of these different things that we believe are going to end the world in the moment. And what does the market do? Over time, human ingenuity takes over and things get better and better and better. Having optimism is huge. And so how does that help us in this scenario? Well, it's like, there's Trump and there's tariffs and there's all this uncertainty. There's always going to be uncertainty. There will always be uncertainty. And so what you need to have is a philosophical frame or a bias towards optimism that encourages you to get in. And that is the most important thing, is getting in. And so hopefully this answers your question, Sam. All in all, it comes down to understanding rolling returns, what are your goals, having a financial plan, making sure your asset allocation and your investments match that financial plan, then deciding, do I want a smoother ride or better returns? If you want a smoother ride, dollar cost average. If you want better returns, get in a lump sum. And behind all of this is the idea of optimism, right? We need to be optimists in order to take advantage of what the market can provide for us. Thank you very much for that question. I appreciate both these questions today. And thank you guys very much. Let me know if you have feedback, if there's any other questions around this.